What's up, guys? I'm Taylor.
And I'm Ryan. If you're new to our channel, we're here to help you make the right choice with your money.
Now, we each have degrees in engineering, and we've been studying investing in finance for a couple years now. We also have some experience in real estate. I'm about to be a licensed agent, and he's bought a house and everything. But we're not millionaires. We're normal guys with normal jobs, so we hope you guys can join us on our journey towards financial freedom. And before we get into this video, we do want to say that we're not like professional financial advisors, okay? We're just two guys on the internet teaching you guys what we've kind of learned throughout our studying and learning and everything, so take that as you will.
And like all of our videos, we're just here for entertainment and educational purposes. So as we learn, we hope you guys learn, and that's the whole point of our videos. And in today's video, we're going to talk a little bit about how to get started in the stock market, how we got started, and what tips we could recommend to kind of save you some time. And general terms that are usually thrown around that we had to look into a lot or figure it out the hard way, and we're going to save you guys the time.
Yeah, this is kind of the video we wish we had when we first got into stock investing and everything. Some of the things you definitely need to consider and have kind of lined out before you actually really dive in. Now, the first step, and this is an important one, is determine what kind of investor you want to be. There are a couple different ways, but it really is dependent on your goals. You know, if you're looking for overall growth in your portfolio, kind of raising your net worth and everything, you can look at growth stocks and everything, things that, will just grow in value over time. But if you're looking for something to supplement your income, get closer to that financial freedom like we kind of are, a great way to do that is to invest in stocks that pay dividends. And we'll get into what dividends are later in the video, but it's just something you definitely need to determine early on.
And in general, growth stocks are typically going to be a little bit more of a risky play, a little bit more of a speculative play. Because if you think about it, and a company's already been around for 100,000 years, and they have trillions and trillions of dollars, how are they going to grow exponentially? How are they going to grow super fast? They usually don't. So growth stocks are going to be the smaller cap companies that typically don't have a lot, and they're starting out, a startup or first on the market. They just had their first IPO, and they are going out, and they are small funded, but people are starting to fund them like crazy. They're getting a lot of attention. Usually those are the companies that are going to blow up. So those are your growth stocks. Dividend stocks are the companies that have been around years or whatever it is, and they have tons of money to their name, and they don't know what the heck to do with it. So again, we'll go into more detail, but those dividends are a little bit of a safer play typically.
Now, that's not to say there isn't any risk. I know in the crazy times, and we're in unprecedented times, so don't consider this kind of the standard. But some companies can change how much dividends they pay out, or if they pay a dividend momentarily. We've kind of been in crazy times with COVID and everything, so those things can kind of be up in the air. So you should definitely look into these stocks and everything. But in general, dividends would be a safer play. You're getting a payout over time. But we'll get more into that later in the video.
Yeah, and our second big tip is going to basically be look into the sector you have interest in. So a lot of us, especially engineers, we have a lot of interest in tech. So we play a lot into the tech space, and we look a lot more into the Apples and the Googles and the Facebook and the Teslas and the Neos and all of those type companies that are going to be really interesting, really future-like, that are going to change the world. Those are the companies we like to see, the technology advancements, the engineering side of things. So since we already naturally do a lot of research into it, we know a lot about the company. So in that, we feel safe putting some of our money in those different companies.
Yeah, and let's say you're a big gamer or something. Look into these gaming type companies. If you're really into that, you might have a better idea of some companies that you know of that are about to blow up and everything. Really, just having knowledge in a certain area and investing in that area is super beneficial for you picking stocks, staying in the game, staying invested and interested in it. You're more likely to follow, and it's very important early on, at least, to kind of have a pretty good idea of what your stocks are doing, what you own, why you own it, and everything. It kind of goes back to that quote by Peter Lynch, know what you own and know why you own it. It's good to diversify to an extent, but a lot of times you need to focus in on one area, and what better area than something you really know and love.
And in that aspect, when you want to lower your risk levels, a lot of times you'll hear about index funds, you'll hear about mutual funds, you'll hear about ETFs. Those are big players as well, and they do help lower your risk levels, but at the same time open you up to many more markets or many more spaces. There are ETFs that we have money in that are only tech, so they own a little bit of Apple, they own a little bit of Facebook. Without you having to own a whole share or a fraction of Apple, you already do by buying an ETF. a share of this ETF. So those are very helpful.
Yeah, you can think of it as basically owning a section of a market. Let's say you invest $100 into this ETF or mutual fund or something, and that fund has 100 companies within it. You can basically, and this percentages, it won't break down to exactly this, but as investing like $1 into each one of these companies, it diversifies you. You're a little bit safer, but you're still in a sector usually that, and most times it would interest you. It would be a good choice.
But that sounds too good to be true, obviously. So there is a catch. There's always a catch. The catch with ETFs, which you do need to look into heavily, depending on what they are, they may or may not pay a dividend, and a lot of times, or almost all the time, they have a management fee or a net expense ratio or fee. Sometimes you can get it as low as 0.02%, 0.06%, and sometimes it's 0.45%. Sometimes it's even higher. So it really depends on the ETF. You always do your own research. Always do. Listen to guys like us. Listen to guys on the internet. Hear their opinion, what they're talking about, what they're buying into, and then go do your own research. That's the quickest way to figure out if it's safe for you.
Now, another thing, you don't want to own too many stocks. There are a lot of players in this game, really rich players in this game, like Grant Cardone, for instance, kind of gives this philosophy of you need to more or less buy into one thing. If you've invested a little into a lot of different companies, let's say you own like 50 stocks and you own $20 in each of these stocks and everything, even if a company blows up, you're not going to see that much growth in your portfolio because you're so spread out. Now, I know a lot of people preach diversification and everything, but a lot of these guys, the hundreds of millionaires, kind of preach this philosophy of you have to buy into one area to really see any type of growth.
And Warren Buffett's a little bit more brutal about it, but it's the same philosophy. He talks about how diversification is simply a cover-up for you not knowing what you're doing. So he's saying if you know how to analyze a business, he said, you don't miss, you pick the Apples early on, you pick the Facebooks early on because you know how to analyze a business and the numbers behind it, then why diversify? Diversification is simply a safe route, try to minimize your risk. So if Apple were to crash, you wouldn't be hurt as bad. However, if Apple were to blow up, just like Taylor said, you won't get as much benefit. So the more risk, a lot of times, the more benefit, the more reward.
Yeah, and that's the classic thing kind of in the stock market. The more risk, the more reward. You go into things like stock, it's a bit riskier. Mutual funds, a bit safer. Bonds, super safe. But you won't see usually as much growth in these safer routes and everything. A number of stocks we kind of recommend to own is like 15 to 20, and that kind of varies on your experience level and everything.
So yeah, this is a pure recommendation from us. This isn't anything that's like statistically proven. If you own 15 or 20, you're at better odds. This is just what we found from our experience starting out. It gives you enough diversification without going overboard. You don't need to own 50 different stocks or 50 different companies.
Yeah.
That's what an ETF is for. But if you put a little bit of money in, you'll follow it a lot closer and you'll learn a lot more. Then okay, do that, but maybe go 25. Just again, a little bit more diversification. Play the safe route until you know what you're doing.
Yeah, because let's say you do get into that 50 range, it's almost going to be impossible to kind of cover your money and track everything because that's too much going on. It'll be more of a task for you.
And that's not just a growth stock. When you mentioned the more money you put into one that blows up, the more money you make. No, it's even dividends. Because if you put $1 into a company that's only paying $2 a year, like for example, like an Apple, then you're more than likely going to get a few cents, few pennies. So again, it's still not worth it. If you're really good at analyzing stocks, then you'll look more into like the 5 to 10 range. You only need 5 or 10 companies under your name. Warren Buffett, I think in one interview, said he only owns one stock in his personal account. And if he had the choice for Berkshire Hathaway, he'd only own 3 stocks and he'd be comfortable. He said, but luckily he found a lot of good companies or decent amount of good companies. But depending on what style you're going for, it varies how many you need to have.
Yeah. And now, obviously, Warren Buffett is one of the pros of pros. He's one of the best in the game. So that's where he can kind of get to that level. When you're starting out, newbies, that 20 to 25 range that we said, until you get a better idea of how to analyze businesses and stocks and everything, is kind of a safe place to be.
And myself, I started, I think, at the 20 to 25 range. And then over time, I slowly go, oh my gosh, I still talk about it today. I can't believe when I bought this stock. Like, that was just something I heard on the internet and bought in. But then I sold it, and then I put my money in a better place because I myself, which maybe not be the right route for you, but I myself am looking to do more dividend investing. So I like to go for companies that, and obviously pay good quality dividends over a long period of time. If, for example, I had a company or two that I purchased, and Corona hit, and immediately they cut their dividend. That's not a healthy dividend. That means the company's already stretching to pay its shareholders, and when a simple bump in the road comes, Corona was a big thing, but even if a simple bump in the road, they might drop it. They might not cut it completely, but they might drop it. So that's not a healthy dividend.
Yeah, and going back on kind of what Ryan said with our personal experience and everything, a large part of it when we first got in, I know for me personally, is you're excited and everything to get into the stock market kind of area and everything. Your emotions are running high. You're super excited. You start hearing about all these different stocks and you want to buy in quick. And a very important thing to do, and it's hard to do at the beginning especially, is keep your emotions in check. And this goes into much bigger concepts obviously, but initially on, it's exciting seeing your money kind of grow and everything, and you're going to want to kind of let it snowball, but our advice is to kind of restrict that as much as possible and keep going on this emotion kind of topic. A very important thing that kind of separates the amateur investors from the pros is keeping your emotions in check when you see the stock market fall. Don't sell out when a big fall hits or a big dip occurs in the stock market. A lot of people start to panic, they start selling out. When you're investing in the stock market, and unless you're day trading or something, which is a much more advanced concept that we won't get into in this video, but you're investing long term. You got to think long term. When a dip hits, you got to be willing and ready to wait that out. This is another thing you should consider when buying a stock. Let's say you're buying a stock and you need to be kind of okay with owning that for years and years. If it's something that you're not going to want tomorrow, don't buy it and everything. So on the flip side of that, don't go partying when your stocks go up, because the stock market is pretty cyclical. Overall the trend is upward, but there will be dips and everything. So once you see your portfolio shoot up 10 or 20%, which kind of stuff happened during the pandemic and everything early on, when everything hit a massive rock bottom, people were buying in and stock markets were shooting up, but the people that were actually knowledgeable on what was going on were able to kind of stay calm through that. A lot of people unfortunately sell when things get low because they're panicking, and buy high when things look so great and everything. The pros do the opposite. They buy low and sell high. So that's just something to keep in mind.
Yeah, and honestly, think about it. Instead of seeing red and going, oh, red is bad, think about it, there's no bad days. If the market's up, the market's green, that means you're making money. That's great. If the market's red, everything's on sale. That's even better. Start buying.
Oh, yeah.
Be careful with that. But definitely, like, if a company that is healthy just dropped because, who knows, they didn't get the best product didn't come out, you're like, okay, they're going to do better. They're going to improve. Okay, let me buy in while it's low, and then it'll keep going up again. So that's a good thing to remember. And Warren Buffett always says, if you're going to buy a company, plan to own it for 10 years or more. So you're looking way down the road, and you're like, oh, I could see this company being something based on its financials, based on what I know about it. I could definitely buy into this company because I plan to hold it for a long, long time. Apple's at the top of the world right now. They don't see them going down very soon. A good time to buy. Even now, they're at the highest they've ever been. People are recommending to buy in. Different things like that you definitely want to look for. So throughout the rest of this video, we're going to talk a lot about the terms that are mentioned when looking at financials, or people. If you're watching a YouTube video, a lot of times you'll hear people mention, like we already mentioned, dividends, growth, compound interest, stuff like that. We're going to go through just talk a little bit about it, because those can get a little bit crazy, get a little bit confusing.
This is the gritty detail that you really need to understand to really start to get into this.
Exactly. It's super, super important, but it's not necessarily the most fun part. It just helps you get to the fun part. So first, talking about that is compound interest. Warren Buffett talks about how compound interest is the eighth wonder of the world, because it's so true. It's so awesome. Actually, my wife the other day talked about, that's weird to say still. My wife the other day just talked about how she hadn't been putting in her 401k for a while, but when she looked back, she had way more money than she initially put. And I was like, all right, let me show you our next YouTube video.
Yeah.
No, I'm just kidding.
Yeah, it's a beautiful thing, compound interest. And this is something that it's basically exponential growth over that simple interest. Simple interest is more linear. You're just that constant interest. This compound interest, you start with your investment, it grows in some interest. Now this interest is calculated based off this new amount, so it just keeps growing and growing and growing and growing. It's super powerful. This is how you can become a millionaire easily and everything. So compound interest is kind of the
eighth wonder of the world.
Yeah, the best thing about
Honestly.
Investing and everything. Now, another thing that we've already referenced several times in this video is dividends. That's money paid to a company shareholders. You can basically think of it kind of as like a gift that the company gives you for owning stock in their company. It's a beautiful thing. A lot of people use it to supplement a lot of their income. Obviously, you're going to have to invest a lot into the stock market to get to that point. But I mean, it's addicting seeing, just 50 cents to $1 come in, and if you start diversifying or to an extent and everything, you get a couple of these companies paying you quarterly or annually, whatever it is, and people pay dividends at different times for different companies. But you see this money coming in. A good idea is to reinvest a lot of that. I know we do that for a lot of our stocks that we own right now, since we're kind of early on in our investment and everything. A great way to capitalize on this compound interest and everything is whatever dividend you get, which is just free money, really. It's just money sent back to you to buy the company. You immediately reinvest into that company, and it just grows, makes that compound interest that much steeper.
$1,000, and then the interest builds on that. And then while the interest is building on that, you're also getting paid from the company. It's like kind of like two payments, and you would always want to, but you don't need to put any more money in again, because due to dividends, as long as it's a healthy dividend and compound interest, it'll just grow and grow and grow forever. So it's a great investment, and that's why I've looked heavily into it, and that's why I fell into that trap, or that I fell in love for that dividend, wanting that dividend, because if I can put enough money in for my weekly or bi-weekly check, as well as the dividends are growing, as well as the portfolio is growing, that means I'm making more money, and eventually I'll make enough dividends that I'll never have to work again, but I'm also having other investments on top of that.
Oh yeah. You mix compound interest with dividends, it's truly a beautiful thing. Another concept that's really important, and we're getting a little bit more detailed here, is EPS, or earnings per share. It's a company's profits divided by the number of outstanding common shares a company is sold. So it's typically good to invest in a company that has a higher EPS and a good historical growth record. So you can basically think of these as how much money the company is making for every share that all these different people own, and obviously you're going to want that. On a lot of these different brokerages and apps and everything, you can track it and everything, and a lot of times a good thing to look at is they'll post what their expected is, and if their actual is higher than that, that they're exceeding their quotas and everything. And obviously don't look at it for just one quarter or anything. You need to look at historically how things have performed, but it's a great thing to look into to determine the strength of a stock investment.
Yeah, and like we said, you got to do your own research. You definitely want to look into it.
For sure.
And there's so many things that go into picking the right company or picking a good quality company, because every statistic can be skewed. So in this example, if there are very few open shares or shares out there, the company doesn't need to make a lot or have a lot of earnings for the earnings per share to look great.
And another thing that kind of builds on what EPS that we just discussed is the PE ratio. And this is the share price per EPS. So share price per earnings per share. It's basically the cost of the share, how much you pay relative to how much the company is bringing in. It's just another thing you can look at, kind of, it's very similar to EPS and everything, but another thing to look at to kind of determine, the attractability of the stock investment.
A lot of times people use the PE ratio to see if a stock is overvalued. So if you're paying thousands of dollars for a stock and their earnings per share, they're bringing in very little money, then the PE ratio is going to be super high, because it's just a division problem. So in that case, it can be skewed again, but you'll also be able to use that statistic along with the earnings per share, along with a couple of other things, to see if a company's overvalued or if it's a good quality company. I typically glance at the PE ratio. That has never once been the only thing I've looked at for a company. I've never bought just based on the PE ratio. But it is a good determinant if you're looking at a company to see if they're overvalued or undervalued. So if a company's earning out the wazoo, but you're only paying 30 cents, then it could be a very, very low PE ratio and you're good.
Which does happen every once in a while.
And also the things that get weird, if a company isn't positive on earnings that quarter or that year, then a lot of times these numbers get super thrown off. And again, it messes them up.
Yeah. All right, so now that we've kind of discussed some of the concepts you need to understand to kind of pick stocks, and there are a lot more things that you should consider once you really get into the stuff, but we're talking about some of the basic things, finding an area you love, looking at some of these basic kind of metrics to determine the strength of the company, looking at the overall growth and everything. But here's some things that you can do when you're actually looking to purchase. Now, these are a couple different ways to kind of buy stocks. First one being obviously just simply a market buy. You're buying right then and there during trading hours what the stock is currently valued at. So whether that be a partial stock, like half a stock or something, and we'll get more into brokerages later about who offers those kind of buy-ins and everything. But a market buy is simply what the price is right now. You're buying at that price, however much of a stock you are trying to get. Another thing is a limit order. Now, this is where you buy at a max price or lower. So you can set, a limit order to where if the stock's up here, once it dips here and it's at that max you kind of set or lower, you're going to, whatever your money or quantity you've set to buy is, it'll automatically be kind of triggered, and now you buy at that certain price. It's a great tool to have.
I love limit orders, limit buys and limit sells. I love them. Limit buys I'll use a lot as well, so I know exactly. I usually put them in the morning, and then I'll have it to the end of the day or the end of the week, and I'll know exactly what I'm going to buy it at, so I don't have to check it every 5 minutes. Did it drop? Did it drop? Did it drop? Did it go up? Did it go up? I don't have to do that. I just put a limit on it. And once it hits that, it'll automatically buy for me. You put in how many shares you want, at what price, and it does all the work. So I love limit orders.
And oftentimes, you can put kind of a time limit on that. So if it doesn't hit this certain limit within a certain number of days or even a few hours, by the end of trading, let's say, that day, that limit order can disappear. So, you have a lot of control over it and everything. It's a great tool to have. Now, another kind of tool going along with this is the stop limit order, which some tools or brokerages like Robinhood will allow you to use. It's if a stock rises to a certain price, it'll then enter in a limit order. So let's say it rises to here, it'll input your limit order here. So once it goes back down to a certain price or lower, it'll buy. So it's just kind of a built-in thing, to see, if the stock has the potential to reach a certain price, go ahead and put in a limit order for once it drops back down. There are so many different things you can do with stocks, so many different ways to buy. We haven't even covered them all in this video, but there are so many different ways and concepts.
You could make tons of YouTube videos, YouTube channel just alone on the different tools, the different brokerages, the different terms for the stock market. That's why it's a whole career just to work in the stock market, is because there's so much involved. So if you guys have questions, please ask questions. If you guys have more interest, please leave comments and let us know that you're super interested in learning more about the dividends. It's already kind of saturated on the YouTube space, but we'd love to explain and show our own opinions, our own experience. If you have any interest, any questions, any concerns, anything we forgot, put it in the comments, and we'd love to see some of you guys have a conversation about it. We love that, have that whole part of it. And the last two things we're going to really leave you guys with are two big tips. The first one is, or I guess three big tips, is first of all, never time the stock market. Never, everyone always says, oh, the market's going to crash soon, the market's going to crash soon, the market's going to crash, the real estate's in a bubble, that this is going to happen, oh, everything's going to blow up, never try and time it. One famous phrase that everybody always says is the best time to invest was yesterday, the second best time is today. So if you're going to wait, think about it. If the stock market, you're waiting right now because you think it's going to crash, you're never putting your money in. 6 months goes down the road, that's 6 months of pure profit, 6 months of growth you could have had if it doesn't crash. Time is the best asset for compound interest. The longer you can let your money sit on compound over time, it's just going to build and build and make it better. If you invest at the age of 30 versus 20, you've missed hundreds of thousands of dollars.
Oh my gosh, and if we were to break it down into a calculator, to show you the concepts of compounding, which we might do. We might pop it up right here in the window, show you a quick calculation of how compound interest kind of works. Something invested at 20 versus something invested in 30, you'd be amazed what the difference is by the time you're like in retirement age or something. It's thousands and thousands of dollars of a difference and everything. But another thing on this whole timing the market thing, it's a real slippery slope. It's a thing that everyone wants to be able to time the market, but the reality is no one knows how the stock market's
Literally no one can.
Yeah. And let's say you're trying to time it and it starts to go down. You're like, okay, it's going to keep going down. I'm going to time it perfectly. Suddenly it shoots back up. You've missed it. Now you're waiting again. It's this dangerous cycle. So you don't want to try and time the market. And there have been countless studies proving that, investing now and holding long term beats out trying to time the market. The best people at timing the market almost always end up with less money than those people that simply bought in right now. Going back to the saying, best time to invest was yesterday, next best time is right now.
If someone could time the market, they'd be 100 trillionaire, maybe more, because they would just buy the right thing at the right time every single time. But it's too hard, too much that tries to go into it that it's not worth it. And don't focus on that. Just be consistent.
Yeah.
Don't try and time it. Don't try and think about it like that. Just be consistent. Every month, every 2 weeks, every week, every Friday, whatever you want to do, put in a certain amount of money. Don't go crazy. Maybe do 2.5% of your income, your take-home pay. Maybe do 5%. Whatever your risk level, whatever you can afford at the time. If you overbought on a house and it takes up 75% of your income, you may want to put a little bit less, maybe like 1% of your income towards it.
You may actually want to reference some of our previous YouTube
videos. Yeah, definitely. Definitely check those out so you can make sure you don't do that. But if you can be consistent and say put in 2.5 or 5 or 10% of your income in, the more the better, obviously. Like we said, it'll compound even to be even more. But don't go crazy. Do not put everything you own into the stock market because it is risky. Just like you said, dividends are usually safer, but they're not the end-all be-all safe. Investing as a whole is a risky game. You're not guaranteed to make profit. You're not guaranteed to make money back at all. So be consistent. Just put a little bit of money in that you can you're okay. Put the money in almost like you're gambling. However, you've put a lot more time, effort, and research, I hope, and you don't lose it.
And stay on top of it too. Keep track of it. This is something that you kind of need to stay on top of. Eventually you can become a little less hands-on and everything. Let's say you hire an accountant or something that can kind of take over this kind of thing. But early on, it's just good to understand the concepts and everything. Really follow your money and everything, which frankly at the beginning, if you're anything like us, you are going to follow your money because you start off, you're like, I'm not a millionaire yet. This money that I'm putting in right now is important, but I just know the possibilities that the stock market holds.
Yeah, so again, if you have any questions, this is a longer video, this is a detailed video, please let us know. If there's any comments you had that we left out, we can either add another video or have a conversation in the comments and really get into it. We'd love to explain everything. So please look into us, follow us on our channel, follow us on our journey. Please like this video.
Yeah, like and subscribe. And we wanted to say that an important concept of this whole investing and everything is a brokerage, okay? We're going to make another video. We're going to post it Tuesday. We're going to set that timeline for us. We're going to post it Tuesday, give you a breakdown of the most popular, the TD Ameritrades, the Charles Schwabs, the Robinhoods, the Webulls, and everything, and give you kind of a breakdown of the pros, cons, because, not all these brokerages do the exact same thing. Some are pretty common with their basic concepts and everything, but it's a very important decision to make. It kind of changes how you'll be able to kind of interact with your stocks and everything. So we'll do a more in-detail video coming to you guys Tuesday, so make sure to keep an eye out. Thanks, guys.
Yeah, thanks for watching. Last thing we just want to say is this video is sponsored by Taylor. Thanks for giving us all the money.